Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
If you're tuning in today to the MHP Exchange podcast, you're tuning in because you're looking for tips, tricks, and operational knowledge that's going to help you in this niche real estate investment class, mobile home parks. I'm your host, Frank Rizzo, and each week on our podcast, we look to share with you insight from operators and people inside the industry to help put you on your path to financial freedom by investing in mobile home parks or real estate and finding opportunity and how to make that opportunity work for you. And a lot of that starts before you even own the property, because you make your money when you buy. You always make your money when you buy. And it's not just about finding the deal or finding the opportunity, but it's in making sure that that opportunity is exactly what you expect it to be. I'm Frank Rizzo, and as we go through today's episode, we're going to talk a little bit about diligence. We're going to focus in about diligence and the one extra step that you need to make if you're going to be a successful mobile home park investor and you're going to be able to take your business to the next step. Because mobile home park investing, we know, is different from every other real estate asset class. I mean, every asset class has its own little nuances, but mobile home park investing especially is different. And we're going to unravel that. But let's go back. Let's take a look at, the finding a deal in the first place. There's a lot of time, energy, resources in finding, especially now, over the last 24 months, it's been especially challenging. We have a lot of new entrants into the space, capital that's been pouring into this asset class, which has made this investing a lot different than it was 10 years ago. When I first started buying mobile home parks, it was not uncommon to look at a deal, and even if it was a value add deal where you knew you had work to do, you knew the rents were below market, because of the lack of capital, competitive capital in the space, you would typically look to acquire these assets at an entry point of 10 to 11 or even 12% cap rate going in. So there was a cash flow that was already generating, and it gave you a large bandwidth or runway where there could be mistakes made. There could be misses in your diligence, or there could be misses in what you thought that opportunity really was, because there was a bandwidth of mistakes that you could make and still be profitable. Today, a lot of that's changed. With the post-COVID, searching for yield, private equity, infusion of capital into the manufactured housing space, it has driven prices up. A lot of these mom and pop owners have been called by not just one, not just two, maybe 5 or 6 different entities or outfits almost on a daily basis. And I will tell you, as an owner operator in multiple states and of multiple parks, I get calls frequently, sometimes multiple people from the same organization calling me on the same day, looking if I have a park to sell. So I could only imagine what other people are facing with at this point. So prices are now elevated, and you as the buyer, as looking for an opportunity, when you finally secure one, there is a natural bias, a tendency to want to make that deal work. You've looked at what the broker may have sent you. You looked at the information that maybe the seller has provided, and you're trying in your underwriting to make the number that you agreed upon work. I mean, we call that confirmation bias. I'm guilty of that myself. When I find an opportunity, I want to see that opportunity work because I like doing deals. I like to see that business plan in action. And when I'm down on the property, if I've had a vision of what that property could be. So I want to make that happen because I'm looking at the impact that could have, that investment could have. But behind all that is the diligence and the numbers and the capital that it's going to be required to make that happen. So when you look at diligence, a lot of people will spend a lot of time looking at the financials, and rightly so. You want to make sure that the income is there and check the bank statements to make sure they line up with what the rent roll is saying or the income statement is saying. And they want to look over the expenses to see exactly where, their utility bills or any divergence of norms happening. Why is there a spike in utility bills one month over the next? Maybe was there a leak that had been fixed? Is there deferred maintenance that needs to be taken care of? And a lot of time is spent on that. And I'm not discounting that at all because I do think that that's not only an important part of it to understand exactly what you're acquiring, but you also want to be able to project based off of those numbers. However, I think that misses a lot of what it takes to make a mobile home park investment work. And what do I mean by that? Many times when we're acquiring a mom and pop mobile home park operation, we understand that the numbers aren't necessarily going to make sense based off of how they have run it versus how we are going to run it. We're not going to be local. We're not going to, while their maintenance expense might be very low, we're going to have to hire somebody, bring in a manager. And I know a lot of people, or there's a theory that you don't necessarily need a manager. You need somebody who oversees the park and maybe sends you pictures. We have found that to really operate a park efficiently, your manager is one of the most important people you're going to have on the ground. I mean, they do more than just take pictures of the park and making sure people are complying or that, people's lots are cleaned. I mean, they're essentially your brand ambassador. They're letting people know that there's what the expectation is. They're instilling the culture down on the ground that you're instilling in them, and they're ensuring a clean run of that community. And to get somebody to do that efficiently and to report properly, that costs capital, right? You're going to have to pay somebody to do that. So those costs might be a little bit different, and we factor that in when we're acquiring any community. But beyond all that, us inlaying our own numbers there, we realize that there's some goodwill in buying a park, and maybe those numbers might not make sense from that 10 cap we used to buy 10 years ago, that we're going to have to assess on what or how long we're going to have to be under our expectations before we can get to our expectations. But one of the key misses that people have, especially in the value add arena, is ensuring that they're compliant with all municipality rules and regulations. Now, what do I mean by that? If you come from the multifamily world, and if you have a 40-unit apartment complex and a tenant moves out, you could easily move a tenant in. There's no additional requirement to get that tenant moved in. If you have a 40-unit apartment complex, you have a 40-unit apartment complex. But if you have a 40-unit mobile home park and 10 of those lots are vacant, to infill those 10 lots, every county, every city might have different requirements of getting those lots activated. You might be approved for 40 lots, but the requirements for infilling those lots may change. And that's one of the key differences. That's one of the key component differences between mobile home park investing than any other asset class. And let me give you a specific instance that happened to us. And this is where diligence is so critical. If we didn't do the right diligence, it would have cost us hundreds of thousands of dollars and totally blew our underwriting and expectations. We're buying a park where our business plan was to infill 10 lots. In order for us to create the value that we needed to in this park, infill was necessary. The market could support it, the numbers worked with it, and we knew that new homes could be brought into this market and the lots could be filled. We went to planning and zoning, and they confirmed that the park was approved for 40 units, that we could infill the units as long as we had an electrical permit, and even if the lots were 2 years vacant or not, we could get them reinstalled. Everything checked out until they mentioned that being that the park was on septic, all we would have to do is get a approval from the Department of Health and flush out the septic as long as the septic was post 1982. As we spoke with the broker about this, he assured us that every septic was put in place and the park was built after 1982. Sounds like everything checks out. But we did not stop there. Because we knew there was another municipality that we had to go to, or another entity we had to go to, we checked with the Department of Health just to confirm what we heard. In talking with the Department of Health, what we uncovered was that even though we were zoned for 40 lots, even though the septics were in the ground, because city water and sewer was available to the site, they would not approve any additional septics because they wanted us to connect to city water or city sewer. That was not disclosed to us before, and obviously that's a huge difference and can make a tremendous impact to any underwriting that we had. So now we have to go back to the drawing board. On a situation like that, you're not going to look to connect one home at a time to a city sewer. You're going to look to, logistically speaking, you're going to have to connect the entire park. So a park that we looked at, or investment we looked at, that was going to be a light CapEx and a light move of lot rents, all of a sudden became a $300,000 unfunded liability. And that's if everything went right. It was going to take us 18 months, which would delay our business plan and create a drag on the investment and put us in the position of having to make up that income on a deal that was, while it was a good deal, wasn't a home run of a deal. There wasn't a huge margin of error. Had we not taken that extra step, we may have been in the hole of from $300,000 to $500,000. So to avoid any potential diligence disaster, if you're looking in the MHP space, you have to look beyond the financials. You have to look beyond of just some of the vendors you spoke with, but you have to make sure you get to every single county entity or city entity that might be involved in infilling any and all lots, making sure that you're going to be compliant not only for the infrastructure, but on lot setbacks, because we've seen this happen in the past where a park may have been built and approved for a certain amount, built at a time and approved for a certain amount of lots, but when they approved that park or they built that park or designed those lots, the home sizes were a lot different than they are today. Because back in the 60s and 70s, they weren't building, they weren't making lots for 70-foot long homes. They were making lots for 50 or 55-foot homes. That is a big difference. So, guys, you're out there, you're looking to get involved in the MHP space, you're looking at a park, in your diligence, invest the extra money, get an altar survey, know where all your infrastructure is, get that from the get-go. Speak to every single government entity that might be involved in permitting and moving in a home or infilling any of those lots. Make sure your numbers are correct. And if you have any questions about diligence, click the link below, send us a message. We'd love to hear about it and walk you through the process, because we want to see you successful in your mobile home park investing. Until next time, I'm Frank Rizzo from the MHP Exchange. If you found value in this episode, rate it on whatever listening device you're on, whether it's iTunes, Spotify, or anything else, because that's how we're able to get this message out to more people. And until next time, everyone, happy investing.